Hey folks, welcome to InTheMoneyStocks.com's intraday analysis video, brought to you by the creators of proprietary price, pattern, and time methodology. Learn the PPT strategies and profit for life. My name is Gareth Soloway, Chief Market Strategist here at InTheMoneyStocks.com. All right, guys, let's get right into the mix today. Markets another quiet, light volume day as there's not major news hitting the markets, but you're still seeing a little bit of the unwinding from the massive rally last week. And again, the fiscal cliff first half of the portion got taken care of, which was the tax side. That created this rally from the low on the SPY of 139.5 all the way to about the highs of about 146.5. So about a 5% rally. I mean, give or take a little bit, but around 5%. And what we've seen over the last couple days is a fading of that move. And again, the big question to most investors is it just a pullback before another leg up, or is there something more significant? And this is the tough question that traders are grappling with, and why you must use the PPT strategies to isolate any chart pattern out there before you decide whether to go long or go short. And again, PPT stands for price, pattern, and time. And by utilizing these methods, which we teach in the Research Center, in the intraday stock chat at InTheMoneyStocks.com, you essentially give yourself an 80-90% chance of winning every single trade. So you start batting better than the institutions. Your annual returns on your portfolio are bigger percentage-wise than the institutions. Obviously, they're going to have billions of dollars, but either way, your percentages will be bigger. You'll never really want to ever invest with an institution again once you learn the PPT methodology. All right, bottom line is this. This is the conundrum. Is this just a consolidation pullback, or is it bigger? The problem that I'm seeing with the market right now is that the headwinds are still ahead of us. We thought that once the fiscal cliff was done, it would be done for good. Not the case. They only solved half of it. All right, the other half is the spending cuts, which is going to have a dramatic effect on the overall economy. In addition, it's tied to the debt ceiling. Obama, the Democrats want the debt ceiling to go up so we can spend more, so this country can spend more money, so we can even just pay the interest on our debt out there. The Republicans say there's no way we're going to let that happen unless you do major spending cuts. The standoff, the lines have been drawn, and this is where we find ourselves. So this is going to be a major event in about 2 months from now that this market is going to have to deal with again. And I think personally, this is going to temper gains on the market. All right, it's very hard for the market to continue to rip higher when there's this lurking out there. Plus, go back to last week when the Federal Reserve minutes were released, and we heard that the Federal Reserve may stop their drug infusions into the market by the end of this year. All right, why is that a negative? Well, remember, the markets are addicted to QE. 4 years ago, QE policy started, the printing of money by the Federal Reserve, and sure enough, 4 years later, it's still going on, but it may stop. The market has become addicted to this. All right, the market looks as this is one of the major influences between then and now, and why the markets are up over 100% from those lows in 2009. When those get taken away, the market is going to be nervous, even leading into it, even leading into the second, third, fourth quarters of this year. If that's going to get taken away, the markets are going to get jittery. How will the market react when there is no stimulus, when there is no drugs being pumped into the market vein? All right, all these plus Europe, plus China, plus oil. I mean, you can name it, folks. Inflation down the line is going to come out. These are just minor problems, or I should say major problems, that are leading the market to have kind of a stall here. In the short term, that's all what I care about. Remember, all I am is a swing trader. I swing trade and I day trade. So my longest term trade usually is 2 weeks, maybe a month. So what I'm looking at really is the influence from the fiscal cliff deal of spending cuts and the debt ceiling, and that to me alone will probably put some headwinds. Plus, we have earnings season coming up as well. Now, looking at the charts, what do we have here? Well, the down move again, beautiful down move. Yesterday we gapped down. Today we opened just slightly lower and sold off. Notice the 200 MA got hit. I talked to my chat room members about this being a buy for multiple reasons, but sure enough, it turned out to be a buy beautifully. If you bought there, look at the market float back up the rest of the day. This is a bearish pattern setup. However, there's always a but, right? However, the one thing to keep in mind is that the volume is dead today. The markets have a lot of trouble selling off, even in a bearish pattern, if the markets have no volume behind them. All right, remember, the markets are inherently positive. Remember, human emotion is positive, generally. All right, unless there's a major event that causes it to be negative, we're generally neutral to positive. Why? Well, I mean, it's just the nature of the human race, I should say. Um, One way to look at it is if you're depressed, if you're negative, what do? You go to a doctor, what are they going to give you? They're going to give you drugs to make you positive. So just naturally, when the volume's this light, you tend to have a market that floats, and even bearish patterns like we're seeing now, very hard for them to play out. In fact, there's no way I would short this pattern just based on that alone, even though it is a bearish pattern overall. Maybe it plays out tomorrow. Who knows? When the volume returns in the morning session, something for us to watch and keep in mind. All right. Again, that's what we're seeing here. Again, really the move of the day was down to the 200. That was the buy on the spiders. You had a little bit of a bounce off double bottom right here from yesterday's lows. You can see this little tail right there, but that was about it. If we go to the daily chart here, here's the market ripping on the fiscal cliff deal. The word rumor came out here. It continued into the new year, and then it stalled out and is pulled back. What's important about this blue line and this pink line is the neckline of an inverse head and shoulders. If it closes below, when it closes below, that will be a very negative signal to the markets and most likely a further downside move. All right, so keep your eyes on that. Right now we're above the neckline, we're not below, but if we did close below in the next few days, that would be very, very negative for this market. All right, looking at Apple today, Apple was down the last few days. Apple is back up today, just up $1.75. So I mean, not much at all. Today, again, being Tuesday, January 8th, the S&P is down 6 points. NASDAQ is down 9. Dow is down about 67 points on the day. And again, you can see Apple actually opened higher and has sold off, but it's starting to come back. Looks like Apple's trying to find a little bit of a base. This is your big baseline right here. I actually gave this same exact level to the pinpoint accuracy to my traders in the intraday stock chat. I said, guys, the line in the sand is 521, which is this low, and then it turned out to be today's lows, but this is even before we saw it get hit. But this is your level right here. I mean, that's everything. As long as you don't get below that, market could float up, or Apple could float up, and sure enough, it has. All right, guys, so that's what we're seeing there. Scanning through a couple of the charts after a big move yesterday on an upgrade by Amazon, or Amazon got upgraded by Morgan Stanley. The stock has sold off today. I warned you guys about this yesterday in this video. In this very video, we talked about it, how this upgrade was coming at 52-week all-time highs and was very, I repeat, very reminiscent of what happened to Apple when it was 700 when it got upgraded. And sure enough, look at the M-top yesterday, actually. Pretty sweet. Okay? Nice M-top there. And then you're actually creating the A pattern now. That's actually a beautiful M-A pattern. It's bearish on Amazon. I mean, that's definitely a bearish chart setup. If it starts to break down, it's going right here. I don't know about today, but by tomorrow, very likely, it could go all the way back there. What's interesting about that level, look at this approximate area right here. Gap fill. So, I mean, 200 gap fill with an MA pattern. Very intriguing to me. Very intriguing. Goldman Sachs is down $1.28 right now. Stock is short-term overbought. You can see it's had quite a run up, pull back, run up, and now it's trying to pull back again. Inside bars could be boding bullishly for the future, but look at the recent run. I mean, just going back to mid-year on Goldman, down from about was around $90 a share. Now it's about $133. Really, it's a pretty impressive move. You have to be impressed by that on the chart of Goldman Sachs. All right. In small cap land, it's been a great move in some small caps recently. One of the big moves came in Free Seas, FREE, a little shipping company. And, you know, I don't really highlight penny stocks like this usually, but this is a pretty impressive move. The stock just a couple days ago was 6 cents. Today it hit a high of 58 cents. These type of runs are occurring in microcaps because of the nature of the January effect. January effect is one of my favorite ways to trade small caps. Again, small caps that have been beaten down will usually run in January as spec money comes back in the market. I've caught quite a few. I mean, yesterday I sold half of Ren at above $4 for a 16.5% profit. DANG is hovering up beautifully, and so forth. So on that note, I'm going to leave you. Come to InTheMoneyStocks.com, take the 7-day free trial, join the pros, become elite, trade for life with an 80-90% success rate. Come to InTheMoneyStocks.com. Take care, guys.